And guys, if I had owned a home in Boston at the time, I'm not sure this would have ever happened. Thank God I didn't. Thank God I was a renter, because that gave me the flexibility to do what I needed to do, reorient my career, and establish my own company and offer huge growth for myself in terms of income into the future. Is buying a home a terrible personal and financial decision for you? Well, when I look at key data across America over the last 25 years related to things like home price appreciation, underlying costs of home ownership, and the negative impacts of home ownership on career development and economic growth, I'm left thinking that yes, home ownership is a terrible decision for you, a lot of you guys, and you really need to arm yourself with the true knowledge and data about what owning a home entails. Because let me tell you guys, there's a lot of negatives, there's a lot of downsides to home ownership that no one really wants to talk about. No one in society really wants to talk about these things because there's so much pressure and vested interest in pumping up the housing market. Think about the 1.5 million realtors out there, or the 80 million existing homeowners, or the big publicly traded property companies like Zillow, Rocket Mortgage, and Opendoor. All of these entities want to see you buy a home today because it's going to benefit them financially. These entities don't really care whether it's a good personal or financial decision for you though. So what I'm going to do in this video is arm you guys with the data you need to make a better decision here in mid-2021 about whether now is the right time to buy a home. In this video, we're going to get started by looking at long-run historical appreciation rates in America so you can have a more sober and objective sense about how much home prices are going to appreciate into the future. Let me just give you a little hint, guys. It's less than you think. The second thing I'm going to do is compare investing in a home to investing in the stock market so you can see what the return differentials look like. The third thing I'm going to do is show you what the real underlying costs of home ownership are in the long run and how you're actually going to lose money on your home. You're not going to make money. Finally, we're going to evaluate some of the negative downsides and consequences to home ownership in terms of your own career development, because you're likely going to be passing up opportunities career-wise if you make the dive into home ownership. All right, guys, let's get into it. The first place we need to get started in terms of understanding whether buying a home is a good financial and personal decision for you is understanding appreciation. If you buy a home today, just how much is it going to appreciate into the future? And the best way to understand future appreciation is by looking at historical appreciation. Just how much have home prices increased in America over the last 25 years? And that's what we're looking at on this graph, data from Zillow. And we can see that the number one market in terms of price appreciation is San Francisco. Prices have gone up by 400% from 1996 to 2021. That means the typical price of a home has gone from $250,000 to $1.2 million. Clearly, anyone who bought in San Francisco in the mid-90s or in San Jose, San Diego, LA, or Seattle has done very well for themselves on their home investment. You can't argue with that. But what I think the problem is that the appreciation rates and the returns of these markets, which come out to about 7 to 8% per year, over 25 years, gets applied to everywhere else. Like, I think everywhere in America thinks that they're going to earn that type of appreciation. But when we kind of scroll down this list and try to find the markets that are like the more typical markets or the average markets, we see a very different story. So for instance, take a look at Charlotte. Charlotte has experienced 136% price appreciation over 25 years. Typical prices have gone from $122,000 to $288,000. 136% appreciation, that comes out to 3.5% per year annually. So 3.5%, that is the typical home price appreciation in America experienced over the last 25 years. And you could see, Charlotte is a market that's like this, Oklahoma City, Baltimore, Atlanta, these are all average appreciation markets. So unless you're buying in some crazy supply-constrained area, you should probably start anchoring your expectations to 3.5% per year going forward. Now, if we scroll down this list, of course, we can see that there's markets that have done much, much, much worse. If we go all the way to the bottom, we can see there's markets like Memphis and Birmingham and Cleveland, where actually the home price appreciation is not even really exceeded inflation. It's been about 2% per year. So if you'd bought in these markets 25 years ago, you actually might have even lost money compared to inflation. And having a firm and realistic understanding of what future appreciation looks like is really important because quite simply, most people do not have a proper understanding of what typical home price appreciation is. 3.5% a year. I think that number probably sounds low to a lot of you. And in fact, I know it sounds low to a lot of you. I actually just put a poll up on my YouTube channel a couple days ago and I asked the question, what do you think the typical home price appreciation is in America? 25% of people said it was 10% per year. 10% per year, except there's been no market in America that's experienced that. San Francisco was the highest, around 8% per year. 2/3 of people thought it was 5% or higher. Only 1/3 of people correctly guessed it was 3.5%. So guys, let's reorient our expectations on appreciation, 3.5% per year. If you're comfortable with that, good. If not, you should reevaluate whether buying a home is a good decision for you right now. Now, 3.5% a year doesn't sound like much, but actually over a long period of time, 3.5% per year compounded actually starts to turn into some real numbers. We talked about Charlotte a second ago. Its typical home price was $122,000 back in '96. Today, it's $288,000 for the typical home, according to Zillow. If you had bought that typical home back in '96 and then sold it today, you'd have made a profit of $165,000. That is nothing to sneeze at, guys. $165,000 is real money. However, guys, that is actually not your profit, right? That's almost your revenue off the home investment. Your profit needs to deduct the costs of home ownership that you incurred along the way. And this is where home ownership starts to get kind of ugly and less attractive. A lot of people don't consider just how much property taxes, homeowners insurance, repairs and maintenance, in some cases even HOA fees, how much that stuff really starts to add up over time. Now let's talk about property taxes. According to Zillow, in Charlotte, property taxes are 1.1% annually of the total value of your home. Over 25 years in Charlotte, over the last 25 years, that would have amounted to $55,000 in property taxes that you are having to pay to the local government because you own your home. So now we need to reduce that $165,000 profit by the $55,000 in property taxes. We're now left with $110,000 in profit. But guys, we can't stop there. We also have homeowners insurance. Homeowners insurance, according to Zillow, is about 1% in Charlotte. At 1%, that means it's about $50,000 over the course of 25 years in costs. So now let's drop 110 back to 60,000 profit. But guys, we're not done. Repairs and maintenance. Repairs and maintenance, things like doing the roof, lawn care, replacing appliances, service calls, painting, all these things. I looked at a lot of different sources and they said assume about 1% per year of the value of your home for costs of repairs, both short-term and long-term, if you were to stash that aside. Interesting how it's always 1%. Well, that would be roughly another $50,000 that you need to take off your profit that you would have spent in repairs and maintenance over the last 25 years. What we're now left with is about $10,000 in profit that you made from the sale of your home. So $10,000 in profit over the course of 25 years. That's about $400 per year in return. I mean, I guess that's something, right? But it's probably a lot less than you guys expected. And remember, Charlotte, this is representative of the typical market in America. Like other markets like this would have been Las Vegas, Atlanta, Pittsburgh, Philadelphia. All these markets had roughly the same appreciation, and they represent a pretty good cross-section of the U.S. And they're basically saying, you don't really make any money in home ownership over the last 25 years. And guys, that's because owning a home is not a wealth generator. It is not an investment. You buy a house because you want a place to live and you want some of the comforts afforded by ownership. You want security that your rent isn't going to get jacked up all of a sudden or you're going to get kicked out. You want security that maybe you have a little bit more space. Maybe you want some projects that you like working on for home improvement. Owning a home is really just about like personal preference. It's not about wealth generation. And the numbers that I just presented prove that. In terms of total dollars, these return amounts to owning real estate are super low. Very, very low. We're talking $400 a year in the typical market over the last quarter century. However, they look even worse when you compare them to other potential options for investment, such as the stock market. The stock market has done about 3 times better in the US than the housing market over the last 25 years. And of course, you always have the option, instead of putting your money down for a down payment and spending all your money on repairs for homes, you could be investing that money in the stock market at the same time and be doing a lot better. You guys can see what I'm talking about on this graph where we're looking at the appreciation in the Dow Jones Industrial Average in the green line over the last 25 years versus the blue line, which is the Zillow Home Value Index. And we can see the Dow Jones has gone up by about 500% since 1996. Home prices in America have gone up by 166% on average. Huge differences. The stock market has done 3 times better than the housing market. And it's also just been super consistent in doing better. We can see that there's really been only one time in history over the last 25 years where the cumulative returns for the stock market sank below the housing market. And that was basically a 12-month span from late 2008 to late 2009 during the last financial crash. Every other time period since then, you could see the green line is squarely above the blue line. And we could even absorb, for instance, a 50% decline in the Dow Jones over the next year and no change in home prices, and the stock market would have still done better than real estate over the last quarter century. So I think an interesting question to ask is, why is the stock market actually doing so much better than the housing market over the last 25 years? Like, I expected the stock market to do better. I wasn't expecting 3 times better than the housing market, especially in the current housing bubble that we're in. And I think it comes down to utility and productivity. When you invest in a stock, or say a company like Amazon or Tesla, you're investing in a company that's developing, or hopefully developing, innovative technologies and processes that are going to change how the world works. I mean, think Amazon basically turned commerce on its head, right? And turned delivery on its head and made it much easier and more efficient for people to get goods. That's high value add to society, and as a result, Amazon's earnings and stock price is going to go up a lot. Tesla is on the forefront of electric vehicle technology, electric vehicle manufacturing. It's doing something that no one else has ever done, and as a result, generating big returns. Caveat, I'm not saying invest in Amazon or Tesla, it's just an example. However, the housing market provides no utility or productivity gains to society. A home today in 2021 provides the same exact utility that a home did in 1996. It's not a productive asset, and thus it will never achieve the same type of returns that something like the stock market will. So it's really important you guys understand this. Once again, a home is not an investment, it is a place to live. It's more similar to something like a car than it is to something like Tesla. Like a car, it's a physical asset, it depreciates, you need to work on it to keep it up to snuff. A house is much more similar to that than it is to a dynamic company that's inventing new technologies and has really limitless potential in terms of profit and revenue. So guys, home ownership, you're likely getting a lower appreciation rate than you thought. Your absolute profit is close to 0 after you deduct your home ownership expenses. And then you're also getting much less than you would in terms of return compared to the stock market. So what is the appeal of home ownership? I think for a lot of people, it's security and safety, right? Especially if you're starting a family, owning a home does confer real benefits to, if you're married and have a kid, there's a lot of benefits to owning a home. And so I'm not knocking home ownership in general for everyone, right? And there's really clear situations where it's a good idea for someone. However, what I see, especially in the comment section into my email inbox, is that there's a lot of people who aren't buying a home or wanting to buy a home for family reasons. They want to do it just to do it. Like, they're excited by the prospect. They're seduced into thinking that they're making a lot of wealth. But guys, let me warn you here. There's a lot of other consequences to home ownership that we need to talk about. Number one is negative impact on your career development. Because as soon as you buy a house and assume a mortgage, it is going to lower your flexibility and ability to take risks as far as your career goes. Your ability to say, just quit your job out of nowhere and figure yourself out and travel and find a new opportunity. Oh, sorry, you have a mortgage right now that you need to service, right? And I just want to actually give an example from myself, my own experience. 2 years ago, I was renting in Boston, and I had been working at a mortgage debt fund for about 8 years. And I had a really good job. I got paid a decent amount of money, but eventually that job didn't quite suit my growth needs, and I quit. I just quit straight up. And I went on this 1 year journey of finding myself, and eventually I started consulting one-off, and then I started Reventure Consulting, and I started this YouTube channel. Now I have 30,000 subscribers, and now I'm making more money than I did at my old job with huge future potential in terms of making even more. And guys, if I had owned a home in Boston at the time, I'm not sure this would have ever happened. I was already so on the fence of quitting, it was really hard for me to do that. If I had owned a home and had mortgage payments to worry about and a big debt burden, I don't think I would have quit. It would have been too much of a risk. Thank God I didn't. Thank God I was a renter, because that gave me the flexibility to do what I needed to do, reorient my career, and establish my own company and offer huge growth for myself in terms of income into the future. And that's just one example. Now, take my case and multiply it across a city or an economy, and all of a sudden you start to realize that home ownership is actually a big negative drag on economic growth. That's right, home ownership is not good for economic growth in the long run in aggregate, the more people that own their home, the more that society becomes sclerotic and less dynamic. And this is not just me saying this, guys. There's been a lot of research on this. I'm going to pull up right now an article from the St. Louis Fed. And guys, this article is from the St. Louis Federal Reserve Economy blog. It's called National Home Ownership Rates in 2005, a Powerful Negative Predictor of Post-Crisis Recovery. And it came out in June 2018. And basically what this research did is it compared how high home ownership rates were in countries back in 2005 to what their post-2005 economic growth looked like, as well as things like GDP per capita and income. And just to get started, you could see here some of the differences in home ownership that exist across America. Like in a place like Switzerland in 2015, 51% of households own their home. In a place like Germany, 52%. Those are low home ownership rates. Places, compare that to Spain, where 78% own, or Ireland, 70% own. The US, you could see in 2015, was at 64%. It's around 65.5% today. So we have a good cross-section, different home ownership rates across different countries to compare. And we can see here, guys, on this graph, a real negative correlation between home ownership rates and changes in growth, economic growth. The higher your home ownership rate was, place like Spain, Ireland, Italy, the more your economic growth declined from 2005 to 2017. Conversely, in places like Germany and Switzerland, lower home ownership rate places, they didn't have any reduction in economic growth over the period of 2005 to 2017. If we scroll down further, we can see that higher home ownership rates are also associated with lower incomes. We're looking here at home ownership rate on the x-axis versus GDP per capita on the y-axis. And generally speaking, the higher GDP countries are the ones with lower home ownership rates. Higher home ownership rates mean lower GDP per capita and income. If you also compare cities across America, you see a similar relationship. A lot of cities in America with really high home ownership actually have really, really low growth. And this is a trend that makes sense when you consider the anecdotal example I gave you of myself. When someone buys a home, all of a sudden their flexibility goes down. When they stay a renter, they have the ability to pursue what they need to pursue, to take risks, to make moves, to change cities. And when you buy a home, your ability to do those things just goes down. It just does. And that's bad for personal career development and bad for overall economic growth. For me personally, the answer is no. I'm not going to be buying a home right now. I'm going to wait until home prices come down to a level that feels reasonable to me, to a level where I don't feel like I'm taking on too much mortgage debt for what the intrinsic value of this home is, and until a point where I feel like in my career that I'm solidified enough that I'm not going to be making any big moves and needing to be flexible. And that's just me personally. I sense a lot of you guys out there are probably in a similar situation. So I just wanted to make this video to educate you on what some of the downsides are to home ownership. Again, this doesn't mean you shouldn't buy, but these are things to definitely consider here in 2021 as everyone else is trying to pressure you to buy. The realtors, all the other homeowners who want to see their prices go up. Publicly traded companies like Zillow and Rocket Mortgage who have a financial incentive for higher home prices. All of these entities are trying to push you to buy and want to get you excited about doing it. This just means think about all the pros and cons, look at the full picture, come up with a realistic expectation of what you think your future appreciation is going to be, your homeowner expenses, and how much money you're passing up potentially by not investing your down payment and your maintenance costs into the stock market or something equivalent. Just think about all of that, and also think about where you are in life and if owning a home is going to inhibit your flexibility and growth potential. So guys, I hope you enjoyed this video and this content. I come out with 2 to 3 real estate data-driven related videos per week. And when I look at the data, actually, I'm seeing that only 15% of the views I'm getting on my video are from my subscribers. That means 85% are not subscribed. I want to change that. I want you guys to subscribe. I want you guys to see this content going forward. I have a lot of really valuable data and insights on the housing market. I also do specific market deep dives every Wednesday. This coming Wednesday, we're going to be doing Phoenix, Arizona, one of the hottest real estate markets in America. And I'm going to give you guys the data to know whether now is the right time to buy in Phoenix from a financial perspective or if you should wait. So make sure to subscribe if you want that content going forward. All right, guys, have a happy 4th of July. I'll see you next Wednesday.